Well, unless you were hiding under a bush for the better part of the last 3 weeks, you know that the Bank of Canada just cut the overnight rate to 2.5%. That's the lowest in 3 years. But before you rush to go pick a variable rate mortgage and jump on the backs of that horse, I need to show you a decision matrix that could save or cost you 25,000 bucks in the next 5 years. And this is not the obvious choice everyone thinks it is. Well, we know that on September 17th, the Bank of Canada cut the overnight rate by 25 basis points. That's from 2.75 to 2.5%. And everybody in the market saw this coming. But what they didn't see coming is what I'm about to show you about the specific math. So, prime rate drops to 4.7% with most lenders, which basically means that variable rates, they're sitting around 3.95% to 4.2%, depending on your lender. But honestly, here's the thing that most people are missing. And this cut changes the fixed versus variable math for everybody who's thinking about their mortgage renewals in the next year completely. The obvious choice might be the wrong choice for your situation as well. I'm going to walk you through the exact decision matrix that I use with my clients. I'm going to show you the scenarios where variable can win big, where it loses badly, and most importantly, how to know which situation that you're in. Now, this episode is a little bit different because we're going to dig into the news and what's happening. But let's be clear, I'm going to dig in more specifically to how to use this information to benefit you. So if you're someone who's on the fence, whether it be getting pre-approved, buying a home, or refinancing, this episode is going to answer all your questions about how to make that decision right now. And if you don't know how to save or avoid losing a crap load of money by the end of this episode, then I completely failed. And I won't do that. So I got you. Stay to the end. If you haven't done so already, make sure to hit subscribe, hit that notification bell. And if you're listening to the podcast, do the same. Hit subscribe. Make sure to leave me a great review if you're finding this information valuable. And if you want to work together, go ahead and click the information in the description and let's see how we can help you out. Let's get into it. First, let's be clear about what just happened to your mortgage options in the last couple of days. If you're currently in a variable rate mortgage, your payment just dropped by about $65 per month on a $500,000 loan. Now, I should tell you that's subjective to your amortization schedule. You got 15 years left. That's going to be different than if you have 30 years left. But that is real money back in your pocket starting on your next monthly payment. So next month, it's tangible. But if you're choosing between fixed and a variable rate today, that $65 savings might end up costing you $25,000 over the next 5 years if you screw up this strategy. And 5-year fixed rates today are sitting around 4.04 to 4.29%. Now, there are a couple out there that are a little bit lower and a couple that are a little higher, but that's kind of a range. Variable rates are about 3.95 to 4.2, and that's about a 10 to 30 point basis spread, which seems kind of small, but it's hiding some massive implications for the average person. So here's the decision framework that you should be making when it comes down to picking. And remember, when I talk about a decision framework, I'm talking about how you come to a conclusion based on your situation. It's not a perfect answer for every person. So the first thing that you need to be thinking about is, can you handle payment increases if your variable rate were to go up by 1%? On that same amortization schedule, that's about $208 per month for a $500,000 mortgage. If you can remember, back in 2023, people dealt with double that, and in some cases quadruple that, because rates went up basically 4.75% over the course of the next 3 years. Second question, what is your time horizon? If you're selling or refinancing within 2 years, the math completely changes versus staying put for 5 years. Now, the third factor you need to be thinking about is, how much rate risk are you willing to take on for these potential savings? Variable rates could save you $15,000 or it could cost you $10,000 depending on what happens next. Number 4 is, do you believe rates are going to go lower from here, or is 2.5% the bottom? Your view on this drives the entire decision. And remember, your view shouldn't be just based on your feelings or emotions. It should be based on the markets and the forward projection of the markets. Now, let me show you exactly how this plays out in the 3 different scenarios, because the right choice depends entirely on which scenario we get. Okay, so for example, in scenario 1, more cuts are coming. Rates drop by, let's say, to 2% by the 2026, which would be another 0.5% lower today. Variable wins by roughly $12,000 over the course of the next 5 years. Scenario 2, that this is the bottom. rates stay around 2.5% for the next 2 to 3 years. Variable could still win, but only by a couple of thousand, $3,000 to $4,000 to be specific. In that neutral scenario, variable still has a slight mathematical advantage, which you don't want to pass over. So it could be win in two scenarios. Now, here's the key insight. In two of the three scenarios, as I mentioned, that variable actually wins, but in the losing scenario, you could lose less than you could gain in the winning scenarios. So let's talk about the third scenario, which is inflation comes right back, rates go up to, say, 4%, the overnight rate, by 2026. Fixed in this scenario wins by roughly $8,000 to $10,000 over the fixed term. But keep this in mind. In two of those three scenarios I just mentioned, the variable rates could actually win. Now, let's get specific to your situation. So if I'm going to walk you through the exact questions that you need to answer to make this decision, question one is, what is your monthly budget cushion? If your mortgage payment went up by $200 per month tomorrow, would that create financial stress? The crazy thing is, if you look at Canadians and the average Canadian out there, $200 could mean a big difference. Now, there's a lot of ways that you can spend $200 differently, whether it be cutting out liquor or maybe going to a few less restaurants every single month. But honestly, who really does that and who wants to do that? We saw the math in 2023 and 2022. And honestly, I think most people could deal with a $200 difference, but it does have an impact to the average person's life. And if the answer is yes, if you're stressed out by a $200 monthly increase, then fixed makes sense, even if it costs you more money in the long run. There is a peace of mind value that most people really need to be thinking of that they don't on a regular basis. The second question, are you planning any major financial changes in the next 2 to 3 years? Selling? Are you renovating? Are you planning to have kids? Maybe a new job, maybe a career change, maybe you run a company. Any of those things, like this could constitute selling your property in the next 2 to 3 years. The variable is probably a good choice in that case because regardless of the rate direction, you're not holding on long enough for rates to actually hurt you that bad anyways, especially if you're looking at the market the way that it's just projected to go. And the third question is, honestly, how do you feel about rates from here? Not what economists say, but what keeps you up at night. There is a personal factor. Like, I can show you the numbers until the cows come home. But if you have this feeling where you literally just can't sleep at night because of what's going to happen in the rate market, then your personal conviction, it's going to affect your ability to stick with the strategy during those times of volatility. Behavioral, like the thing about money is that if you haven't read the book Psychology of Money, a lot of it comes down to your mindset around money and the things that you do, because people make a decision like, I want the cheapest rate, but then they do the thing that costs them more money. Like, I want the cheapest rate and I'm going to take a 5-year fix, but then it ends up costing them more money, whereas they could have taken a variable rate, which could have saved them more money and not being the cheapest rate today. But because of their emotional decision-making matrix, they ended up paying more money than they had to. But here's what September's rate cut tells us about where we probably go from here. The Bank of Canada cut despite inflation being somewhat sticky, which means they're worried about economic weakness more than price pressures. The policy, like the priorities signal like a future direction. You can see that. And the BOC is prioritizing growth support over inflation concerns. If you're reading between the lines of the central bank's communication, that you can get a general idea as to what they're thinking. They specifically mention trade uncertainty and weak business investment. And those problems don't get solved by a 25-point basis cut, which means there are underlying economic issues which suggest they likely needed this and potentially need more. With trade disruption and weak investment, it does require potential sustained support from the policy. And this is setting the expectation that we may and likely could see additional rate cuts. My read about this is that it isn't a one and done cut. We probably see at least one more, probably two, possibly two, over the next 12 months. I wouldn't be so excited or dramatic to say that this cut is one of two that we see in the next 6 months, but the rate trajectory expectations should really inform the decision that you make today. And the things that you do should not be based on purely this one thing, but more around what the government is, or the BOC is really telling us about what is an important factor here. I mean, the economic fundamentals suggest continued easing bias, which provides us with a market outlook to inform this decision. That strengthens the case for a variable rate mortgage, but only if you can handle the payment volatility if I'm wrong. And I'm saying if I am wrong because I'm giving this information, but I would not be right or wrong because I'm just providing you objective feedback based on what they said or didn't say and trying to gather this information. So you need to make this decision, which is why I provide you with this matrix of decision making. Even strong conviction requires some level of risk. Like, what level of risk am I willing to deal with? Am I willing to deal with the upside of the potential interest savings and the low penalties in exchange for the $200, $300, $400 difference in my monthly payments? That choice really requires the ability to handle adverse scenarios. So here's your immediate action based on the cut back on September 17th. Here's the specific steps. If you're currently in a fixed rate mortgage above 4.5%, run the penalty calculation right now. If you don't know how to do that, we have a calculator. If you can get that prepayment penalty, get a quote from your bank, send it to us along with your mortgage balance, amortization, and term, and I'll send you the rate cut analysis to show you if you could save money to make it more profitable. Because in today's rate environment, it actually could make sense to break it, pay it out. We've gone through a stage earlier this year where it made sense, and then it kind of went away, and it could be back again. If you absolutely need payment certainty, take that 5-year fixed rate mortgage, as I mentioned, and just sleep well. The potential savings are just not worth the stress for anyone in this case. Peace of mind has real value that varies, and it totally depends on you as an individual. And if you're okay paying for that, then pay for it. And that's why it's not a rate question, it is a term selection question, and then you have to look at the other factors. And if you want someone to run specific numbers on your situation with today's new rates, it's exactly what we do given this information. Now, the September 17th rate cuts themselves, it changed the mortgage landscape, but it doesn't have to change your fundamental decision framework. The methodology still remains the same, whether it was a rate cut, a rate staying the same, or rate going up. You just take this information, you apply this to your specific circumstance, and you look at the data. And no, you are not expected to have to know all this data and information. You need to be informed by a professional that reads this every single morning before they go into the office and or receives this information and reviews it on behalf of you. I think the mortgage industry is absolutely crazy and backwards, and it's focused, especially from the banks, more on closing sales than understanding data, which is why every single person on my team has to read the data every single morning, and they get an update along with something like this every week to understand. The variable rate mortgage is mathematically favored today in most scenarios, but only choose it if you can handle the payment risk. And I understand that is not right for every person, which is why I do not recommend this for every person. And the truth is, the worst mortgage decision is the one that keeps you awake at night, regardless of what the freaking math says. Now, if you found this decision framework helpful and you don't want to have to try and figure this all out yourself, subscribe here to get immediate analysis every single time there is a rate change, and I will break that down. Plus, I'm going to get breaking down in the near future which lenders have the best variable rate decisions and discounts, and of course, more importantly, the different options that would be available. Now, one more time before you leave, the decision matrix, just so I summarize this up. A, the payment tolerance test. B, the time horizon. C, the rate outlook. D, the tolerance. E, the current rates. And F, these scenarios. Which one is going to win? If you found this information helpful, give me a thumbs up. See you in the next podcast. Thanks for joining. Alex McFadden here at Flow Mortgage Co. I'll see you on the next one.